Items of gross income. Income taxation schemes refers to the different methods of taxing income earned by corporations. There are three main schemes: final income taxation, capital gains taxation, and regular income taxation. Note, it is essential to identify the type of taxpayer in the income earned to determine which income taxation schemes applies. Final income taxation. This refers to the situation where a taxpayer's income is subject to a final tax, meaning that it is taxed once and then the taxpayer is exempt from paying further taxes on that income. Key points. First, final taxes. The full tax amount is withheld by the payer at source, making it a final payment. Second, payee receives net income. The payer receives their income after taxes are withheld, leaving no need for additional tax payments. Third, payer's responsibility. The payer is legally required to remit the tax to the government. Fourth, no need to file tax returns. Since the payer has already withheld and remitted the full tax amount, the payee does not need to file income tax returns. Fifth, final withholding tax system. This system is commonly referred to as the final withholding tax system. 6. Applicable only on a certain passive income. Final income taxation is only applicable to specific passive income sources listed under the tax code. 7. Not all passive income is subject to final tax. Not all items of passive income are subject to final tax, only those specified in the tax code. Active income, also known as regular income, which income earned from one's own effort and involvement, typically requires a significant amount of time, effort, and responsibility. This can include working long hours, being directly involved in the work, and being accountable for the outcome. Examples of these are compensation income, business income, and professional income. Passive income refers to income that is earned without requiring the taxpayer's direct involvement or active participation. Examples of these are interest income from banks, dividends from domestic corporations, and royalties.
Now let's proceed to the capital gains tax. What is capital gains tax? A capital gains tax is the tax on profits realized on the sale of non-inventory asset. The most common capital gains are realized from the sale of stocks, bonds, precious metals, real estate, and property. Here are the types of capital gains tax: short-term capital gains and long-term capital gains. Short-term capital gains are those gains that are realized after selling the asset within the purchase of 36 months. Long-term capital gains are those gains that are realized after selling the assets by holding it for more than 36 months period. Now, here are the two types of capital example: finance and human capital. Financial or economic capital is necessary in order to get the business off the ground, and human capital is a much less tangible concept, but its contribution to a company's success is no less important.
Regular income taxation. This is considered as the general rule in income taxation. The following are subject to RIT: 1. Active income. 2. Other income, which can either be gains from dealing in properties that are not subject to CGT. Other passive income not subject to FIT. Note, from this, it can be said that income subject to RIT are those not subject to CGT and FIT. Number 3, similar to CGT, RIT employs the self-assessment method.
Section 2 of the revised Corporation Code, RA number 11232, defines a corporation as an entity form by legal mandate, possessing the rights of succession and the powers, attributes, and properties explicitly granted by law or inherent to its existence. For the tax purposes, the term corporation encompasses various entities, such as partnerships, joint stock companies, joint accounts, associations, insurance companies, and one person corporations, added by the Create Law. However, certain entities, including general professional partnerships and joint ventures or consortia, engage in specific activities like construction projects or energy operations under government service contracts, are not classified as corporations for income tax purposes.
Classification of corporation. There are two types of corporation. One of that is domestic corporation. It is a corporation created and organized under the laws of the Philippines. Example of that are the San Miguel Corporation and Jollibee Food Corporation and other establishment or corporation that is under the law of the Philippines. And second corporation is the foreign corporation. It's a corporation created and organized under foreign laws. It can either be one of the two, resident foreign corporation or non-resident foreign corporation. Resident foreign corporation has a permanent establishment branch in the Philippines, acquiring a residency for tax purposes or doing businesses in the Philippines. Example of that is the Apple. And second is the non-resident foreign corporation, has no permanent establishment in the Philippines. As you can see in the table, there are types of taxpayer. And domestic corporation is taxable within inside the Philippines and also without or outside the Philippines. It is taxable. And resident foreign corporation are taxable only when within or inside the Philippines. If without or outside the Philippines, it is not taxable. Then the resident foreign corporation is taxable within or inside the Philippines and not taxable without or outside the Philippines. Classification of corporations. Domestic corporation, taxable income from the sources within and outside the Philippines. Resident foreign corporation, taxable income from the sources within the Philippines. Non-resident foreign corporation, gross sale or receipt from the sources within the Philippines.
In other corporate income taxpayers, the first that we're gonna be tackled about a partnership, and it's two types of partnership. So first, what is partnership? So partnership is a business organizations owned by two or more persons who contributed their industry or resources to a common fund for the purpose of dividing the profits from the ventures. So partnership is the relationship between two or more people to do trade or business. So each person contributes money, property, labor, or skill, and shares in the profits and losses of the business. So the first type of partnership is what we call the General Professional Partnership or GPP. So it says here that a partnership formed from the exercise of a common profession. All partners must belong to the same profession. So this it is a form by person for the sole purpose of exercising their common profession, not part of the income of which is derived from engaging in any trade or business. So this professional Partnership can have more than 20 partners. So, like for example, is a professional firms include engineers registered under Professional Engineers Act, lawyers registered from under Legal Profession Act, and architects registered under the Architects Act. So, this kind of partnership is a type of partnership not making business but rather exercising or practicing their common profession. So take note, a JBP is not treated as a corporation and therefore not a taxable entity. However, the partners are taxable in their individual capacity with respect to their share in the income of the partnership. So the second type of partnership is what we call the business partnership. So what is business partnership? The business partnership is an arrangement between two or more people to oversee business operations and share its profit and liabilities. So let's proceed to the joint ventures. Joint ventures is a business undertaking for a particular purpose. It may be organized as a partnership or a corporation. So, joint venture, two or more business decide to combine their resources in order to fulfill an enumerated goal. So, for example, two companies may decide to form joint venture in order in order to build a new factory together. So by sharing the cost of construction, land and machinery, so each company can reduce its individual expenses and benefits from the economies of scale. So there are two types of joint venture. The first is the exempt joint ventures form for the purpose of undertaking construction project of engaging in petroleum, coal, geothermal, and other energy operations pursuant to an operating consortium agreement under a service contract with the government. So it means at any time, any business entity that is not a note party whose equity interests are directly held legally or beneficially by a note party or group of parties. So the second type of joint ventures is taxable joint ventures. All other joint ventures are taxable as corporation. The third is a co-ownership, a joint co-ownership of a property formed for the purpose of preserving the same and or dividing its income. A co-ownership that is limited to a property preservation or income collection is not a taxable entity. As such, it is exempted, but the co-owners are taxable on their shares in the income of the co-owned property. But a co-ownership that reinvests the income of the co-owned property to the other income-producing properties or ventures will be considered an unregistered partnership that is taxable as a corporation. So, like for example, if two brothers purchase a property that would be considered co-ownership, both brothers would have to agree if the property were to be sold, and the two would share the proceeds from the sale. However, the original purchase of the house was not necessarily intended as a profit making transaction.
What is a tax base? A tax base is the total value of all of the assets, income, and economic activity that can be taxed by a taxing authority, usually a government. It is used to calculate tax liabilities. So when we say tax liabilities, these are the portion of the tax base that is collected. And they come in many forms including income, property, capital gains, and sales taxes. So the tax base for regular corporate income tax, it refers to the total income earned by a corporation that is subject to taxation. This includes revenue from sales, services, investment, and other sources, minus allowable deductions and adjustment as per tax laws. The resulting taxable income is then used to calculate the corporate income tax liability. So the tax base for minimum corporate income tax is a fixed amount set by a tax authorities that corporation must pay regardless of their actual taxable income. It ensures that even if a corporation's taxable income is low or negative, they still contribute a minimum amount in taxes. This minimum tax base is often determined based on factors such as revenue, assets, or a combination of both. The tax base for non-foreign resident corporation, it refers to the portion of income generated within a particularly country's jurisdiction that is subject to taxation. This typically includes income earned from business activities, investment, or other sources within the country's borders. So, non-foreign resident corporations are taxed on their income derived locally, often with specific rules and rates applied to ensure they contribute to the tax revenue of the country where they operate. So, let's go. Let's break down the formula step by step with an example. So let's say a business has the following financial information. Gross sales receipts is 100,000, discount slash return is 5,000, cost of goods sold slash cost of sales is 40,000, itemized deduction slash OSD is 10,000. So we can plug these values into the formula to find the taxable income. So the first step is we're going to subtract the gross sales minus discount slash returns, or 100,000 minus 5,000 is equals to 95,000. And then proceed to the second step. So in order to get the gross income, we're going to subtract the net sales minus cost of goods sold. So, or 95,000 minus 40,000 is 55,000. So the third step is, in order to get the taxable income, we're going to subtract the gross income minus itemized deduction, or 55,000 minus 10,000 is 45,000. So in this example, the taxable income will be 45,000. This formula helps to calculate the taxable income by starting with the gross sales slash receipt, subtracting any discount slash returns to get the net sales, then subtracting the cost of goods sold to get the gross income. Finally, itemized deduction are subtracted to arrive at the taxable income. So that's it.
The regular corporation income tax rate, also known as the RCIT or normal corporate income tax, is 30%. This rate applies to all corporations regardless of whether they are domestic or foreign. Method ensure that income and expenses are evenly allocated over the fiscal year, and the appropriate tax rate is applied for a period with different rate as per section 278 of the tax code, amended by the rate law. Taxable income is correctly allocated and taxed according to the rate in effect during the different part of the year. The same process can be applied to compute the minimum corporate income tax (MCIT) when the rate is reduced from 2% to 1%.
So let's move on to tax rates, regular corporate income tax. Illustration: ABC Corporation, a domestic retailer, has taxable income of 690 million pesos for the calendar year ended December 31, 2020. Its total assets is 180 million inclusive of land and building, amounting to 50 million pesos and 25 million pesos respectively. How much is the income tax due? So since ABC Corporation does not qualify for the reduced rate of 20%, the applicable rate will be 25% beginning July 1st, 2020. Accordingly, the computation of the RCIT shall be as follows. For the net taxable income, it will be 690 million pesos. Divided by 12 months for the year 2020, it will be 12. So the taxable income per month will be 57 million and 500,000 pesos. So for tax due, January 1st, 2020 to June 30, 2020, there will be 57 million and 500,000 every month for 6 months, and it will be times 30%. As mentioned, for all corporations is 30%, notwithstanding if they are domestic or foreign. If you will calculate those, you will get 103 million and 500,000 pesos. However, on July 1st, 2020, the effective rate shall be 25% under the CREATE law. So that will be 57 million and 500,000 pesos times 6 months for July to December times 25%. The answer will be 86 million and 250,000 pesos. So we will add both of them and you will get the 189 million and 750,000 pesos. So that's the total RCIT due or regular corporate income tax.